This is Iris, a realtor and landlord in the Pioneer Valley, Massachusetts. Today, we'll go through the first step in value estimate of an investment property. We'll talk about the Gross Rent Multiplier, GRM, and the Capitalization Rate, cap rate. To most of our investors, the way we look at the investment properties is a little different from the way we look at our home. It's a more detailed data analysis and less emotional involvement. We want to know whether this property will make us a good return now and in the years we own it. At minimum risk, of course, we will look at the return from different angles. Let's first review the pros and cons of investing in real estate. We all know that investing in real properties is safer than most of other investments since people always need a place to live. Most of us remember what Mark Twain said, "Buy land, they're not making it anymore." Well, Elon Musk is trying to develop more land on Mars for humankind. And I don't think that I will be able to afford any in my lifetime. Even if Elon is super successful on Mars. Come back to 2021. One of my focus is to hedge against potential inflation. Knowing we can borrow against the property value, now at a very low interest rate, and knowing our investment properties will appreciate since I'm investing in long term. Also knowing our government gives us investors a good tax benefit through tax deductions for operations and through property depreciations. Of course, there are drawbacks in investing in real estate, and the major drawback is the lack of liquidity. It takes a few months or longer to sell a property and complete the entire transaction. It also takes time and resource to own and operate rental properties. There are some volatilities involved with real estate investments also, like any other business, especially if you invest in short term. While getting to the property valuation, when an investor finds the right property, the first question is usually, how much is this property worth? Properties are valued in one of three ways: market value, investment value, and replacement value. To investors, a property's investment value is more important and will be our focus in this series of videos. Today, we will cover the Gross Rent Multiplier, GRM, and the Capitalization Rate, cap rate. Topics of cash flow and the cash-on-cash return will be discussed in the next video. We start with the simple screening number, Gross Rent Multiplier, GRM. GRM is a quick method of determining value of an investment property compared to others in the same market. It equals to the property's market value divided by its annual gross income. GRM is useful for comparing investment properties for further analysis. The lower the GRM, the better. Lower GRM means that your rental property will take less time to pay off. One investment rule of thumb is called the 1% rule, and it says the monthly rent should be equal to or greater than 1% of the total purchase price of an investment property. When the monthly rent is 1% of what you paid for the house, the GRM equals to 8.3. Therefore, GRM of the investment property should be lower than 8.3. GRM is good, but a little bit too simple. So if the GRM number looks good, let's look at the capitalization rate, the cap rate. The cap rate measures the rate of return based on the net operating income. Well, that means what you can bring in minus all your expenses. Cap rate equals to net operating income divided by the property's market value. So the higher the cap rate, the better. In my opinion, you need to get your cap rate higher than 5%. If you can get it higher than 8%, it's quite good. Cap rate counts the operating expenses such as real estate tax, property insurance, liability insurance, repairs, utilities, and upgrades. Cap rate also accounts for occupancy rate, since the property wouldn't be rented out 100% of the time. And most real estate investors put a 5 to 10% anticipated loss of rent into their calculation. A lot more numbers than the simple 1% rule already. Let's look at an example duplex house I once looked at. The asking price is $439,900, and the current total rent is $2,850 per month. The very first thing pop up is it doesn't meet the 1% rule. Assuming I have to keep the rent the same, then I need to get this place at $285,000 or below. Well, it wouldn't happen. I haven't seen a seller sells for $155,000 less than the listing price yet, unless it's $1 million or multi-million-dollar house. I look at the expenses of the property a little further, and here is the list. We need to count the property tax, the insurance, the repairs, the yard work, and the services. After I add all the expenses together, and assuming 90% occupancy rate, I got 3.2% cap rate, way too low. Well, this two-family house is not a good investment property, since the GRM is too high, 12.9, and the cap rate is too low at 3.2%. Most real estate investors think that the cap rate makes a better indicator of the performance of an investment property. However, a property's operating expenses estimate may not be accurate for new investors. Therefore, the cap rate is more difficult to verify as opposed to GRM. GRM is a simple, solid number. Cap rate doesn't take into account of debt service such as mortgage either. Right now, the mortgage rate is very low, and it has been low for some time. As a result, some investors are willing to invest in properties with a low cap rate. A cap rate of 4 to 10% is considered a good range for the pandemic year. Well, that's it for us for today. Next time, we will look at the cash flow and the cash-on-cash return. Thank you very much for watching. See you next time.